That's completely legal to do.
Absolutely. They're paying 60% income tax.
60?
You're almost forced to stay out of the UK, and because it's an overseas property, HMRC can charge 200% as a penalty.
Oh, God.
Actually, for a 20% taxpayer, it's a 10% increase.
Company formation for the purpose of UAE property purchase, even advisable, not advisable.
Structure the exit correctly.
I'm paying the installments, even then I have to pay 60%.
Yeah. So with that one, this is where you don't need to tell them if you don't make any income from it. As soon as you're in the UAE, if you've got £1 million in your pension fund, you can just withdraw that out, completely tax-free on the UK soil. They would look to charge that entire company's profits to UK tax.
The UAE tax-free for Brits. Welcome to Investopedia episode 8 or 9, I've forgotten now, but this one is about taxes, and I have with me here a tax expert from the UK to help you guys. Joshua, I'd love for you to introduce yourself.
Yeah, firstly, thank you very much for having me on. I'm here to hopefully share lots of valuable information about UK taxes. As we're going to jump into, Dubai is tax-free, but the UK isn't, unfortunately. But for a little bit about me, I'm a UK chartered tax advisor. We've got our own practice actually in the UK and also a practice in the UAE as well. So we can cover both areas, assisting expats that are coming here, helping people move from the UK to the UAE, getting all the tax things right. Because ultimately, when it comes to leaving the UK, it's easy to get to Dubai. It's nice. Once you're here, there's no tax implications to worry about. But actually, for people that still have property in the UK or investing from the UK, that's a little bit tricky. And that's where sometimes you can trip up.
Yeah. So I think the benefit here is Joshua is exactly specialized in that thing, which is moving to Dubai, etc.
Yeah, absolutely. Because a lot of people might think, even just kind of a bit of a warning for everybody, you've got a UK accountant.
Yeah.
But 95% of UK accountants aren't familiar with international tax.
Yeah.
They don't know how the structures work. They don't know about the UK tax system when it comes to leaving the UK.
Yeah.
So you can't just rely on your UK accountant and think that it's okay. You do need a chartered tax advisor. You do need a specialist. You need to work with somebody who's probably done it themselves, like I have, and helped hundreds of other clients through the same process.
Like for an appendicitis, you don't go to a gynecologist.
Okay. Exactly that.
Okay. Before we get into the tax stuff, I had a few jokes for you because I'm a comedian. Okay. Tax jokes. Okay.
Yeah. Okay.
As a property broker, I spend my life telling people how much they can make. You spend your life telling people how much they can keep.
Yeah. That's not even a joke. That's just facts.
I make people rich. You tell them, well, not that much.
Yeah, you're not that rich.
I was going to tell an HMRC joke, but they took 40% of my punchline.
Yeah.
Okay. I wish I was British and paying taxes because one brown envelope from HMRC makes you lose your appetite.
Yeah, that's a good one. Trust me, it does. When you see those brown envelopes coming through.
Yeah. Have you seen those Unite the Kingdom marches? Nothing unites Britain more than HMRC. Tax advisors are only busy one season, all of them.
Yeah, 100% true.
Do you actually get phone calls in March from people saying, hypothetically, let's say I forgot to declare an expense?
Yeah.
Or,
is this a joke now?
No, it is. Okay. I am glad to be speaking with you because you're one of the only people in Britain who get excited by the phrase allowable expense.
Yeah, 100% true.
Okay. So the way I've done this is I've divided this into 3 segments. The first one is about living in the UK.
Yep.
Second one's about moving to the UAE. And the third one's about generally business owners. Some of these questions are going to overlap in a way. So, but we'll have time stamps in the video. So, living in the UK, the first generic sort of question is Dubai actually or UAE tax-free for Brits?
Short answer, no. So when it comes to taxation, especially with the UK, what the rules are is fundamentally, if you're a UK tax resident, you pay UK taxes on your worldwide income and gains. Yeah. So if you've got property in Cyprus, you've got overseas dividends, you've got even get a salary from a UAE company, it's income from property, because you are a UK resident, all of that income is brought into account and fully subject to tax in the UK at 20%, 40, 45, and actually for property income, next year, those rates are going up in the UK.
Oh, God.
So it's now 22% for the basic rate, 42%, and then a whopping 47% for a high earner.
And how much is the increase?
2% increase, which is, well, we say 2%, it's 2% in change to the rates, but actually for a 20% taxpayer, it's a 10% increase.
Yeah.
Actually, when you frame it like that, you're like, well, okay, that is a big jump. But actually, that's a 10% increase on that tax.
Jesus, okay. Okay, so if there are taxes, so what's the difference? Like, if I'm in the UK and I live in the UK, I work in the UK, if I'm salaried versus self-employed and
Yeah.
I have a property in Dubai, do I have to report it myself? What's the process? Like, do you have to contact you? Do you have to tell HMRC, I've got a house? What if it's a holiday home? What if it's an investment?
Yeah, so you don't need to tell them if it's a holiday home. So if you don't make any income from it, then you don't need to disclose that to HMRC. It's only where there's income.
You can officially send money to Dubai and not tell HMRC at all, as long as it's a holiday home.
Yeah. As long as it's your own money. So with the kind of phrase "sending money to Dubai," as long as that's your current income, so your savings, your personal savings, you can use that as you wish. If you use that to purchase a property in Dubai as a holiday home, there's no HMRC reporting obligations.
Okay.
It's only when there's money, basically there's money coming in, there's tax to be paid, that's when HMRC need to know. So the question there was, well, actually, how do you let them know?
Yeah.
And that's all complete on your UK self-assessment tax return. So if you're self-employed, you've got other properties, most people are in the self-assessment system. Tax year runs April to April. You've got to do that by the 31st of January, following the year after the tax year finishes. And all of your overseas income would need to be included on that. So actually, if you've made 100,000 dirhams rental income, you'd have to convert it at the current exchange rate, put that in your self-assessment, and then that would be added to your other income in the UK.
Oh.
So to give you an example, if you were to earn £100,000 a year self-employment profits or a salary in the UK, that's going to use up most of your tax bands.
Yes.
You would then have 100,000 dirhams, so say £20,000. That would be added to your other income, which actually in the UK would then mean you lose your personal allowance, and you end up paying 60% income tax on that rental income. 60%.
If you're £100,000.
Yeah, but because of that one, not too many people know about this, but when your income exceeds £100,000 in the UK, you lose your personal allowance. So that's the 12,570, they're tax-free.
Yeah.
You actually lose that. So for every £2 of income that you have, you lose £1 of that, which creates an effective 60% tax rate for income between £100,000 and £125,140.
Yeah. So if I'm making £100,000 from my salary in the UK and I have a £20,000 rental income coming into Dubai, I have to pay 60% of this 20,000.
Yep.
Oh.
It's absolutely crazy. So a lot of people, it's where you don't really want to go over 100,000. So a lot of people would either use pension contributions, or if your employer offers you a pay rise, actually it's not worth it because I'm only getting £40 out of every £100 rent increase from my salary. So you just don't want to go in that area because of the tax rate you end up paying.
What if I've paid 50% on a property, taken a 50% mortgage from the bank in the UAE, and I'm paying the installments, most of my rent or all of my rent is going into that, even then I have to pay 60%?
Yeah. So with that one, this is where a lot of, if you're a UK-based property investor, you'll know about this, but in the UK, they had something called Section 24. Have you heard of that?
Well, basically, heard of it,
typically, in a normal world, mortgage interest, your biggest expense as a property investor, you can fully deduct that because it is a genuine expense. Whatever's left, you'll pay tax on. They changed that back in 2016, so actually now you can't fully deduct the mortgage cost, the mortgage interest. What you get is a basic rate tax credit, so we're going to 22%, which means that you end up paying even more tax because the tax bill that the tax is calculated excluding the mortgage interest. And then what happens is, okay, you've paid £10,000 of mortgage interest. We'll give you £2,200 off your tax bill, and then ultimately you're probably paying 50% more tax.
Oh, okay. So I have a property. I took a mortgage on it. I'm paying 60% on the rent, even though all of the rent is going into that property.
Yeah.
And if I forget to report this, what happens then?
That's a bad position to be in. Because HMRC, they do have all this information, it's all AI supercomputers, they know your nationality, your passport number, it's all linked to your Emirates ID, so the information's there, and at some point, it wouldn't surprise me if it's probably happening already. The UK is setting up a Dubai task force almost to probably look at all the people that have gone to Dubai, that are in Dubai, that have properties in Dubai, companies in Dubai, and are ultimately losing HMRC money by not paying taxes. But what would actually happen is HMRC would write to you in one of those scary brown envelopes and say, we think you've got a property. Do you have income to report for this? And then there'll be penalties and interest on the tax underpaid. And because it's an overseas property, HMRC can actually charge 200% of the tax owed as a penalty.
Oh God! Okay. So it's
just report it.
What if, so they can basically check their local bank accounts here, UAE bank accounts. They've got the treaty.
Well, not necessarily sharing the information, but what HMRC will do is they'll go to you and say, we want those statements. We want those overseas bank statements. They'll know that you have an account, But they don't usually get it directly from the bank themselves, but they'll say, okay, we know you've got this overseas bank account. We think that you've made £200,000, so we want a £100,000 tax bill. You've got to prove otherwise. So with HMRC, the burden of proof is always on the taxpayer.
Yeah.
They'll come along, they'll make an assessment and say, okay, you've got this property. We think you owe us, £500,000 as an example, where actually the real figure could be £100,000. And then you've got to give them all this information to change their mind to make the tax bill what it should rightfully be.
Yeah. Jesus, okay. So they can't check your account. They'll ask you for it.
Yep.
They'll send you a random tax bill according to what they think. Okay. Okay, this has a weird question in my head. So let's say I'm a Brit and I have friends in Dubai, and then one of those friends owes me money.
Yep.
They send me money in my own local bank account in the UAE. How do I tell the HMRC? Is this even allowed? Like, if I have debt or credit, and I'm using other overseas accounts to do that, as long as I'm reporting it, it's fine, right?
That one wouldn't need to be reported. If it's just your friend owes you money, you're making loans. All of that is capital movement. So any actual underlying capital where you're moving it from one pot to another, one friend, they're going to pay you back. There's no tax issues around that, whether you lend from the UK to the UAE, Jersey company, whatever it might be. With HMRC, it's all about income and gains. So have you made a profit? Are you charging interest on that loan? Is there a capital gain?
Okay.
Then if any of those are true, absolutely that needs reporting. But just moving money around, sending it to overseas accounts, there's no requirement to report that to HMRC at all.
Okay, one more question. You said that if you have rental income, you have to tell them automatically that this is the rental, this is the tax. How do I calculate based on like Google rate or bank rate of the exchange?
Yeah, exactly that. So you just literally Google spot rate for the day.
But that's you never get that, by the way, in the bank. So hypothetically, if I want to bring £20,000 back into the UK, I'm going to pay so much more.
Yeah.
Do I remove that fees that the bank will charge and then give them the amount? Like, are they like really crazy about?
They're not too crazy around that. As long as it's there or thereabouts, they're relatively reasonable on that basis. So any foreign conversion fees, that would be an allowable expense.
Okay. And if it's a holiday home, nothing. Is there an annual property tax that we have to pay, or just rental income? There's no tax for like you hold a property in Dubai.
Not for in the UAE. In the UK, there is usually an annual property tax. It's called ATED. Annual tax on envelope dwellings, and that's essentially if you own a property in a UK limited company that's valued at more than £500,000, there's this tax to pay. There are quite a few exemptions, so if you let the property out on commercial terms, you don't pay the tax, but you've got to claim the relief. But if you did have a limited company that owns a property that you lived in, then that tax could apply. It very rarely applies. It used to be because a lot of rich Arabs used to own a lot of high value property in London. It was very inheritance tax efficient. So HMRC come along, saw what was going on, put this extra tax in, and now it's less attractive.
Okay. And company formation for the purpose of UAE property purchase for a British person, is that like a hoax, or is it real? Like, is it even advisable, not advisable? What do you say about that? Yeah,
so in terms of the tax-wise, it makes sense, but it's more, especially buying property in Dubai with a company is difficult. You need certain type of companies. It could be an offshore company, very expensive to set up and administer, compared to just
renew each year.
Renew each year. So unless you are buying really high value
tens
property,
of millions,
tens of millions, just looking at the differences, you really need to be earning a couple £100,000 rental income to make it.
But what's the benefit of doing it?
The benefit of that is the rental income belongs to the company rather than you personally. So when you invest in your own name, if you're a UK taxpayer, that's got to be declared on your UK self-assessment. But if it's a company that owns the property, the company owns the profits. And the tax bill, it all sits in that corporate entity. So in that case... But you own the company. There's some anti-avoidance there. So if you're a UK resident and HMRC can prove that the place of central management and control, basically where does the business genuinely get run from, where are the management decisions, if they believe that to be the UK, then they'll actually charge that company to corporation tax in the UK. But if you do have all the board meetings in the UAE, you've got a management team, and you can prove that actually the company is genuinely based in the UAE, that then gives you the ability to benefit from those low tax rates, the 9% corp tax. You don't take any money out personally, and then you don't need to pay UK taxes on it. So the moment you take the money out back into the UK, now you have to pay. Now you have to pay the tax. So and just dividend tax. Yeah, dividend tax. So it could be up to 39.35% for an additional rate taxpayer. So having that corporate layer just gives you the flexibility over when you take it out. If you know that you're going to be in the UAE in 2 or 3 years' time,
keep it
you
there.
let it build up and then you take it out.
And that's all official and legal, by the way.
Yeah, absolutely. But for a lot of people, that's not feasible because you need to be at such a scale where you can have a management team in the UAE. If HMRC can prove that you approved a property purchase, you were doing any sort of business really for that UAE company whilst you're in on UK soil, they would look to charge that entire company's profits to UK taxes.
Okay, I just had a weird idea. So let's say I'm a British property owner or like investor, and my brother or sister is in Dubai working, okay? And then I gift them money to buy property in their name. Is that completely legally allowed, and then it'll be tax-free for them?
Yeah, that's allowed, but only on the caveat that they don't give you that rental income
back
in cash. Yeah, you can give them the money, that's absolutely fine, but it can't be some almost a sham arrangement where they're going to give you the property back at some point, they're giving you the money back or just transferring it to your bank account or giving you cash. If HMRC could prove that, then they'd argue that actually it's not a legitimate purchase, it's a transfer of assets, transfer of income streams, and then they would look to put the income back onto you.
Oh God, okay. There's no way out, it feels like. They've thought about this, basically.
The only way out is to get out. That's it. You can't, when it comes to taxes, even when it comes to the real world, you can't have your cake and eat it.
Yeah.
So whilst you're in the UK, it's very difficult to really save tax, to really build wealth. The only way to get out of the tax system is just to get out of the UK.
Yeah, that's what they're doing.
Yeah.
That's why they're buying all these off-plan properties, because they're 4 years away, 3 years away. That gives you time to build up a portfolio. By the time they're getting ready, bam, 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 income starts, you move.
Yeah. That's what we're seeing a lot of people do. It's quite a few of our clients, they're brought over the last 3 or 4 years, and then they're waiting for them all to finish, and then they're saying, okay, you know what, we're happy to keep building the portfolio, and then as soon as that taxable income starts to arise, as soon as the rental profits are coming, we're going to be gone. We're going to be in Dubai.
Yeah, that's what I've noticed. Okay, I have some scenarios. Okay, so let's say it's a husband and wife jointly owned property. Husband is the higher income owner and owns 10% of the property. Wife owns 90%, makes no income in the UK.
Yep.
And what happens to the let's say £25,000 rent? 90% of that is for the wife.
Yep. That's how it works. So in the tax side of things, 90% of that, so what's that, 22,500? That will be reportable on the wife's self-assessment. Yes. Fantastic. That's a great tax planning strategy. For married couples, we always suggest equalising your income. So if he's a higher earner, we want to use as much as possible for her. And probably what we'd then do is actually, why 90%? Can't we do 99%? Just really save a couple of extra £100 in tax. But that's how it'd be reported. It'd go up both their self-assessments, but with just their percentage share of the rental income, expenses, profit.
And that's completely legal to do.
Absolutely.
Husband, wife, father, daughter?
Yeah, anybody. Just me and you today. If it was 50-50, 60-40, anything like that is a matter of fact. It's written into the deed of the property. Yeah. So it's not an arrangement, it's a commercial decision. That we're going to buy this property. Okay, because of taxes, we're going to structure it this way. Yeah. But it is a genuine arrangement, and it is structured in that way as a matter of law.
Yeah. So is it like considered a gift in terms of...
it's not a gift. It'd only be a gift if there was an element of gift in the transaction. But if you're just going in, buying the property, one person might put more money in as a deposit, that's not a problem. But actually, they're just giving you a higher or lower percentage ownership. Yeah. But that wouldn't usually count as a gift, especially between married couples. It could do if you were to put it for a father-son example. For inheritance tax in the UK, income tax, not relevant, but for inheritance tax, if they were to buy the property outright but then give 99%, there would be an element of gift to that transaction, but that wouldn't impact income tax at all.
Okay. So basically, family people can like sort of play around with this legally and reduce their tax. Okay. Scenario 2, let's say there's a 3 million dirham, or let's say pound, 3 million pound property sold for 6 million pounds in 3 years. Okay. 2022 pound was 5.2 and 2025 pound was 4.5. So it's 1.5 million pounds how much is it? 3 million pounds of profit.
Yep.
Okay. In 3 years. But then the transaction is in dirhams, okay?
Yep.
So how is the capital gains tax calculation done? Is it just how much money you sent?
Almost. It's a case of, so how much you sent. So actually, what was the conversion rate the day you purchased, which would line up to how much you've sent, effectively, because you've got to get the money to the UAE. And the same with when you sell. Okay, so if you do the bank transfers, it keeps it nice and easy because you've got the pounds to dirham to buy the property, and now you've got property to dirhams to pounds, and then whatever the cash proceeds are is pretty much your capital gain, and that's what's taxable.
Okay. So what they're looking for is the pound figure.
Yep.
Okay. What if you made profit on the appreciation of the pound?
Yeah, you pay tax. Of course.
They can't get away with anything. Okay. Okay, segment 2. Let's say they've now moved to the UAE.
Yep.
Now, is it now tax-free from day one? Or have you like arrived from the UK, started a brand new job, opened a new business, whatever, started minting like 100,000 dirhams monthly? Now what?
Right, it depends on when they move as to whether it's tax-free. In terms of if they left during partway through a tax year, then that can be a split year. Then I'd have to look at the case for them actually leaving the UK as to whether it's nice and easy to get out of the UK tax system. It can be possible for you to move here in October, but actually still remain UK tax resident for that full year and potentially pay tax on your UK on your worldwide income for that year. So you'd have to structurally exit correctly and make sure that you get the split year treatment if that's applicable. If you don't, make sure that actually you do have to pay tax on your Dubai income for that tax year. Then it might be the following 6th of April when you are fully non-tax resident and can start to benefit from the favourable tax regime in the UAE.
It sounds like a bad divorce. Like if you don't do it right, you'll
they're gripping on. They want absolutely everything out of you. they want the dog, the kids, the house in Malibu, both cars.
Okay, so I think this brings up the statutory residency thing.
Yep.
What is it, by the way?
The statutory residency test.
Yeah. So I think it's something to do with 183 days, 90 days. I'm very confused because I'm not British, but I think you should explain it at this point. And how is this proved to HMRC?
Yep.
Again, is this self-reporting? Like, this is how many days I stayed here. This is how many days I stayed in that country. How do we give them evidence? Like, considering it's all smart gates, there's no stamps, maybe just flight tickets. I don't know. Tax residency certificates from the UAE government. Like, what's the process?
Yeah, so in terms of the kind of first point there, statutory residency test. So actually the statutory residency test is quite a good thing because previously to this, understanding your residency was quite opaque. Okay. It wasn't clear cut whatsoever. It looked at kind of ties to country clubs, place of habitual abode, all of these kind of terms that people don't understand. Yeah. And it made it difficult to get a clear answer as to whether you were a resident or not. It was, I think it's 2012 or 2013, they brought in the statutory residency test. And it basically, you work through it in order. You can get loads of nice flow charts online. It's a case of, well, are you automatic UK resident? Well, how long did you spend in the UK? Was it more than 183 days? Is the UK where you had your only home? And you basically go through these series of questions to arrive at a conclusion of, yes, you're a UK resident, no, you're not resident, and then off the back of that, you can plan. As part of the statutory residency test, there's something called the sufficient ties test, which confuses a lot of people when it's like, well, can I have my home? Am I allowed to start bank accounts in the UK? Yeah. And that's the last section of the test. It's first automatic non-resident, automatic UK resident, and then the sufficient ties test. Yeah. But we advise most people to try and get a result for the statutory residency test by either being, but ultimately, automatic non-resident. Because when it comes to the ties, again, that can be a little bit opaque. You might not think you have a tie. HMRC could come along and you do. And the more ties you have, the less time you're allowed in the UK. So actually, if you budget 90 days, but actually you're only allowed 46, then you might not know it now, but in 2 or 3 years' time, HMRC will come along, they'll assess you on your worldwide income and gains, and there's a massive tax bill to pay.
Okay, so if I'm moving to Dubai, and I've got a job here as a Brit, and then I've got a bank account back home, because I want to pay my parents or friends or whatever, I go back, and then I have a house that I bought, that's okay?
Yeah, that's absolutely fine. It's just about understanding the bank account, that doesn't constitute a tie, but the property does, if it's available for you. So if you spend at least one day in it, it's available, then that counts as a tie. So it's fine to have it, but you just need to understand the impact it has on the number of days you're allowed in the UK. For most people, like you mentioned there, in your example, you're working in Dubai. As long as you're working full-time overseas in Dubai, that's the 90 days, which is what a lot of people, that's the kind of criteria that a lot of people fall under. They get the 90 days, it's happy. But actually, if you wanted more days in the UK, you thought, I actually want 120, you might say, I'm going to sell my house, or you come to me and say, Josh, I want it a little bit longer in the UK, what can I do? And I'd say, okay, we need to sell the property, because then we can look at the sufficient ties test, evaluate your ties, you've not been UK resident, you've not been in the UK for more than 90 days out of the previous 2 tax years, so actually we can change your facts to make it so that you have more or less ties and allow for more days.
Okay.
So it just depends on your personal circumstances and kind of what you want out of life, and then we can try and make sure that the tax side mirrors up to that.
Basically, before moving, everyone should sit down with you and like...
Pretty much.
Yeah.
The only time you probably shouldn't is if you are genuinely just a full-time employee, you've not got any assets, you've not got any property, you're just hopping on a flight and coming out here, then there's pretty little value I can add.
Yeah.
But for anybody with material assets, businesses, any complication, they want to keep properties back in the UK, offshore investments, you need the tax advice just to, at the very least, get peace of mind that you are doing it right, and in most cases, actually get the advice to do it right.
Yeah, okay. What's the exit tax?
So there's no formal exit tax in the UK for individuals, but there is one for limited companies, and it's basically a migration charge. So if you were to have a valuable company in the UK, you then move that company to the UAE,
Yeah.
then actually the limited company or the business in the UK is deemed to have sold all of its assets, pays corporation tax on the capital gain, and then it's free to move. It doesn't apply to that many people because most people that do move here where they've got UK businesses, the business stays in the UK.
Yeah.
So very rarely, we've actually never seen it actually apply because it's the individuals that move rather than the company. Or if people do come over here, they might set up a new company, but it's only really for kind of large companies in the UK where we're moving the whole thing to the UAE, which for most people doesn't make sense.
Yeah.
You've got UK customers, you've got UK staff, so you do need to keep that UK company there.
Got it. Okay. So not applicable for most.
Absolutely.
Yeah. Okay. So for business owners, regular business owners who are moving to the UAE, if they are if they've got a British business in the UK running, and they want to move that here, let's say they've got online services, online products that are maybe the products are manufactured internationally in China, I don't know. So they're stored in UAE, shipped from here, the customers could be everywhere.
Yeah.
So when they're moving and they open up their business here, if their customers are all in the UK, then what?
Yeah, so that one we'd have to look at the exact business, but usually we'd probably suggest keeping the company in the UK or assessing it to say, okay, can we move some of it? Can we set up an overseas subsidiary to help basically reduce some of the UK corporation tax?
Yeah.
But most of the time, because there could be an exit charge, because the company's established, it's usually just easier to keep it in the UK than to fully try and move operations to the UAE or somewhere else.
Yeah. Oh, weird question. So let's say I have a UK company and it's making a lot of money, but I move to Dubai, and then I want to pay myself a salary or dividends or whatever. Is that taxable now?
Yeah, well, it's tax-free, so it's not taxable. In terms of you paying yourself, if you are doing work from the UAE, absolutely you can pay yourself a salary, but it's got to be market value.
Yeah.
And to get that tax-free, you need to get an NT tax code from HMRC, which basically means you need a UAE tax residency certificate first.
Yeah.
Headache to get the NT tax code from HMRC. But if you've got a UAE company, then your management, your consultancy charges, you can just charge your UK company a management charge. It's got to be reasonable. It's got to be arm's length. You can't just go in and charge 100k a month. HMRC won't be happy with that. But if you're working 30, 40 hours a week, genuinely adding value to the UK business, £10,000, £15,000 a month isn't unreasonable for most.
Yeah.
And then the UK company pays that to Dubai. The UK company's profits are lower, thus lower corporation tax. In the UAE, you've got the 9% corporation tax over 375,000 dirham. But by the time you paid a small salary out, you're not going to pay much tax at all in the UAE on that income.
Yeah. Okay. What happens to my NHS if I have moved out of the UK with the tax residency?
Yes, if you're a non-tax resident, you don't qualify.
What?
Yeah.
They won't even emergencies. They help everyone.
Yeah, but emergencies help everybody. But for routine, if you're not resident, then the HMRC or NHS's view that you're not resident, so you shouldn't be using the NHS.
Oh wow. Okay. So you can basically pay for the NHS throughout your life.
Yeah.
At 40, you move to Dubai, come back for vacation.
Yeah.
You have a whatever problem, and then you're going to get denied.
Yeah, you have to start to pay.
Oh God. Okay. What happens to a British person's ISA, LISA, whatever, UK dividends?
Yeah, so you can keep them open, but you can't contribute any new money to them.
Oh.
That's the main thing. So you can keep it open, so if you do ever come back, it's definitely good to, if you do have ISAs, LISAs, keep them in place. Don't just sell them out and then put them into a general investment account, because then what happens if you do go back to the UK in 5 years' time, well, actually that's now outside of that tax-favoured wrapper, all the income and gains from that taxable. So you keep it in place, keep the investments, but where you're non-resident, you can't put fresh money into an ISA.
Okay. UK stocks, etc. You don't. What happens to pensions?
What about it? So in terms of your UK pension, they just stay there. So until you crystallise them, if you've got a limited company, you can put further contributions in. And I think if you're if you've not got any other UK relevant income for taxable purposes, you can put £2,880, I'm pretty sure, into a pension. But realistically, there's no benefit to doing that. It's a question I get asked all the time: can I still put money into my pension? And then my question is, well, why would you want to do that? When you're in the UK, you put money into your pension because it's tax favourable. You get it off of your income, you get the tax relief.
Yeah.
You're in Dubai, you don't pay tax. So actually, why would I want to put that money into a pension when I'm not going to get any tax relief, to have it locked up for 30, 20, 10 years, when actually you're better off putting that into property, which is still going to give you the return, which is tax-free, which you can access that capital now if you need to, or a general investment account for stocks and shares.
So a lot of people who are employees or employees who have been paying for their pensions, they've got like 4 or 5 properties now in Dubai. They're going to move when they're 60-ish. Okay, so their pension starts releasing when they're 65, right?
57, I think, at the minute.
So if they move to Dubai and they're living here, they're a tax resident here, what happens to that pension coming in, receiving?
Tax-free.
Oh.
Tax-free. And actually what you can do as well is, we worked with quite a few IFAs on this recently, is you can take the full pension amount completely tax-free in one lump sum. In the UK, you only get 25%. So when you crystallise the pension, you get 25% tax-free of your pension. The rest of it, as you draw it down, you pay income tax. But actually what you can do is, as soon as you're in the UAE, you get a tax residency certificate. If you've got £1 million in your pension fund, you can just withdraw that out, completely tax-free. The main caveat behind that is the 5-year rule, temporary non-residence. If you go back to the UK within a 5-year window, you get absolutely smashed with tax on that. You'd lose about half. But as long as you stay in the UAE or go somewhere else, then actually you can get your whole pension out tax-free, which you never could in the UK.
Yeah, as long as you're staying 5 years.
Yeah, always. Okay. Anything, especially when you're leaving the UK, capital gains, dividends, there is that 5-year window, which is basically the temporary non-residence rules. It's what it's called. Because prior to this, you could actually, it used to be kind of like Spain and Portugal, people would go for one tax year, sell their assets, which had big capital gains, come back to the UK the next year, and it was fine. It's crazy to think I wasn't alive, or very young then, and I couldn't benefit from that, but that was the case. So HMRC thought, hang on a minute, that's a bit too generous. We need to make it 5 years to show that actually it's not quite as easy as that. So if you've got large capital gains, if you've got dividends or pensions, you've got to be outside the UK for 5 full tax years.
Yeah.
If not, if you come back year 3 or 4, you will pay tax on all the dividends or the pension income that you've got, that you've taken over that 4-year window, which could be millions, and then have a tax bill in the millions as well.
So every single Brit moving from the UK to Dubai is unintentionally or intentionally forced to live out in Dubai. Because if they go back...
Yeah, if you've sold a company, if you've taken large dividends, if you've taken pensions, if you've done any sort of large crystallised events, then you're almost forced to stay out of the UK, because if you go back and become a tax resident within that window, you get hit with a tax bill.
Sorry, so if I move, I have no money, I have no assets, I move out of the UK, I come to Dubai, I make a lot of money for 2 years in Dubai, tax-free, go back...
That's fine. So in that case, it's fine. It's only when those gains are in place when you left.
Okay.
So if you've lived in the UK, you made a lot of money in the UK, then you think, okay, I want to sell some stuff. Then you go to Dubai. Well, actually, because all of that wealth creation, all that value you accrued whilst you're a UK resident, it's subject to the 5-year rule. In your case, because you made all the money whilst you was out in Dubai when you were non-resident, that's fine. You could go back after 3 years if you needed to.
Okay.
But for a lot of people, especially kind of your audience that are buying off plan now, well, actually, that property is going up in value now whilst you're a UK resident. So when you bought somewhere and you might sell for $1 million, it's doubled. You're in the UK now, so you can't just sell that tomorrow or next tax year. You'd have to commit to that 5 years non-residence to get that CGT free.
Okay. So if you want to sell your assets in Dubai, if you're investing right now, if you want to sell all of that for profit and use that cash, move to Dubai for 5 years. Basically,
especially if the gain accrued whilst you're a UK resident, you've got to be 5 years. If people are investing now, they've just come out here, you've given them some fantastic deals, in 2 or 3 years they're going to sell. As long as that value built up whilst they're a Dubai resident, they're not going to worry about the 5-year rule. But for everyone that is a UK resident now, they are investing now, then you've got to worry about it.
Okay. Then we're reaching the end of it, but do you have any FAQs like common mistakes people make something that you want to highlight?
Yeah, so I suppose the 5-year rule is a massive one that a lot of people completely overlook.
Yeah.
Not fully understanding exactly how it works when it comes to the overseas assets, when it comes to dividends, pensions, but ultimately just not being aware of it. So they might think they can come to Dubai for a couple of years, or even on the flip side, a lot of people, maybe where they've got salaried income, think that they can't come back to the UK. But overseas salaries, they're not caught by that 5-year rule. So you could come to Dubai, work for 1 year, you come back to the UK next tax year. Well, actually, that's completely irrelevant. All that money's been taxed in the UAE when you were tax resident, so you can just come back to the UK. There's no tax issues. So it's definitely fully understanding that. And then the second trip up would be around the statutory residency test. So
Wait, is the non-dom thing the same thing as...
the non-dom thing's completely different, but they've scrapped that now in the UK.
Oh.
So they've got rid of that. Previously, non-domiciled was where you were mostly born outside of the UK. Your permanent home was outside of the UK potentially, and then you just came to the UK for a short period, although it can be years. And ultimately, that allowed you to have a beneficial tax treatment. Your overseas income and gains, as long as you didn't remit that to the UK, weren't taxable.
Okay.
But for a lot of people, it didn't apply. Anyone born in the UK wouldn't be eligible for it. But they've changed that now, and they've got a kind of a 4-year foreign income and gains transitional window. But ultimately, that tax loophole's gone.
Okay. Any red flags that HMRC looks for, common ways people get caught doing dodgy things?
So what they look for, HMRC, they look for things that don't sound right. So anything, that's kind of how a lot of there's kind of two ways there's 2 ways that you're likely to get any sort of HMRC audit is. One, they've got information from somewhere, so they do get a lot of information from all these different sources, whether it's banks, investment accounts, even in the UK, letting agents have to disclose the properties they're managing to HMRC for their clients. So they've got information that you've not told them about that should have been reported. That's one way, and then it's something that doesn't look right. So actually, you put a tax return in. Last year, you made 100,000. This year, you made 5,000. But then your expenses don't look right, or there's basically some sort of anomaly that looks different to previous tax returns or other individuals' tax returns in the same space.
Yeah.
And then the third way is just complete random luck. So they're the kind of 3 main ways that you might get a HMRC investigation.
Okay. Strange question. So let's say I'm a British person and I have UK stocks, US stocks, okay, in the UK while I'm in the UK.
Yep.
Now I move to Dubai and I sell them on the UK app because we have different apps in Dubai. Am I supposed to transfer those stocks in different apps or just have a different portfolio here and sell that? Or how does it work? Because stocks are online. You don't it's not physical.
So, that's not physical. I suppose when you have a stock in an app, if you were to sell that and even rebuy the same stock, that would be a taxable event. So it's a bit like crypto. With crypto in the UK, when you spend that, so we're in Dubai, you can go pay for your coffee with some crypto.
Yeah.
In the UK, that counts as a disposal. So actually, although we might look at it like it's a currency, but actually HMRC look at it as an asset. So if you've got a large capital gain on that, each time you use that, you'd be triggering a small little taxable gain and pay taxes on it. And the same is true with the stocks. So if you were to try and move brokerages, unless you're kind of a high net worth client where they'll just kind of transfer the actual ownership or the the custody of it between brokers, most apps you'd have to sell it, rebuy it, which would mean a tax bill as soon as you sell it.
Oh, so high net worth people will just have change in brokerages.
Yeah, unless you've kind of really high net worth where you can just, whoever your broker is, they'll actually just change who's looking after it, basically like a property managing agent. But for most of us that are using apps, you'd have to just sell it and rebuy it on your new platform.
So it's not just that, let's say I've got stocks in the UK account.
Yep.
I move to Dubai. Now that I sell the UK account stocks, it's not just tax-free automatically because I live here?
That one will be. So in that case, you sell the stocks, even that's UK stocks, you come to Dubai, that's tax-free, but because you were in the UK, you've got stocks, if they've gone up in value, you've now just come to Dubai, there's the 5-year rule that might catch you out in terms of if you've got big gains, being trapped outside the UK for 5 years.
So across all assets, crypto, stocks, property.
Yeah, absolutely. Okay. And then kind of one thing, a lot of people potentially moving back to the UK, this is definitely kind of a good tip. If you are looking at moving back to the UK, is basically make use of your tax-free status whilst you can. So especially with good assets like crypto, stocks and shares that you can easily sell and rebuy, before you go back to the UK, you want to sell everything and then rebuy it back at today's value so that all of the gain that you've been sitting on for the past couple of years while you're in Dubai, that's washed out, that's tax-free. and then when you later sell it when you're in the UK,
it's from the new value.
The new value, not the original.
Oh, that is so cool.
It's called rebasing. That's
Yeah.
definitely, if you're looking at going back to the UK, that's a must. Absolutely essential you do that.
Very, very cool. I don't think of that. Okay. Any simple checklist for someone moving to the UAE, or a simple checklist for someone who's investing? That's it.
Yeah, a simple checklist. It's
Speak to you.
yeah, basically speak to me. To be honest, we do have some checklists on our website, jsmprivateclient.com, that we've kind of put together that do fit most people's circumstances, can give you a bit of an idea. So definitely check that out. But ultimately, yeah, get some professional advice. You know, you might not want to pay, you might not think you need it, but if you do want to make money and keep it, getting the tax right is absolutely essential.
Yeah. And speak to someone who's got actual experience with this kind of thing.
Yeah, exactly that. That's in Dubai now, knows Dubai, knows the UK, that it can actually help.
Okay. Any last things, advice you want to give to anyone?
If I suppose not necessarily advice, but just kind of a parting comment. Really, if you can't get the Dubai tax benefits whilst being in the UK, and if you're in the UK, you're paying half your income to HMRC. So actually, if you do want to make your money work for you, get out to Dubai, UAE, or somewhere where the tax treatment and the economy and the environment is actually allowing you to build wealth.
Yeah. All right. Thank you so much for your time. Really, really appreciate you coming out. And I'm sure this will be very useful for our buyers. And all your information is going to be here. So, of course, you can reach out to Joshua. And, that's all. Thank you.
Absolute pleasure.